This is the time of year where you start spending time on the weekend, laying back and watching classic episodes. Why is it that most of the year I can't be bothered with classic movies, but you get here bordering into holiday season, and all of a sudden I'm all about watching Speed 3 for the 14th time, or Die Hard. I'm all about watching these shows. And actually, I was kind of kidding about Speed 3, but I'm not kidding about White Christmas. I watch White Christmas every stinking year. Not my favorite holiday movie. My favorite holiday movie is an oldie called Christmas in Connecticut. Fantastic film if you haven't seen it. But that's not what we're talking about today. Today, we're going to give you a line that's going to kick off everything today. And it comes from one of my favorite movies of all time. And if you are watching on Facebook, first one that puts this in, where this movie comes from, we're sending some swag your way. How about this line? I don't think that means what you think it means. Live from the 3-room apartment over Uncle Jack's garage while the basement's being renovated. Hey there, stackers. I'm Joe Saul-Sehy, Average Joe Money on Twitter. Welcome to the show where we take not one, but two headlines ripped from the financial press, and we not only read those like some shows do, we actually talk about what they might mean to your wallet. Isn't that wild? But we don't stop there. Then we combine those into something we call the big idea, which is an idea you can take and spend the rest of the day. Stacky Benjamins and Money in the Morning have a brand new partner here. Thanks to Hurdler for supporting Stacky Benjamins. By the way, that's spelled Hurdlr. Hurdlr. Just get rid of the last E. Hurdler automatically tracks all your mileage, expenses, income streams, and tax deductions in real time to save you time, money, and headache. Average user finds over $5,600 in tax deductions with a mobile app and an online platform. Hurdler helps entrepreneurs, whether they're at home or on the go. So if you're an entrepreneur, you'll find more at hurdler.com. I like using Hurdler because, I want it to be easy. I want to pay attention to my business. I don't want to pay attention to all the bookkeeping stuff. Not that much fun, where the business is a blast. And by the way, Kelly gets it. Kelly, I'm going to message you as soon as we're done here. Kelly's taking home some swag. That was from Princess Bride earlier, but we're not worried about Princess Bride now. We're worried about things that might mean something different than what you think they mean. And Laura, kick it off for us.
Here are today's Money in the Morning headlines.
Thank goodness October is over. Wasn't that just fantastic in a not so fantastic way? What I mean by wasn't that fantastic was it sucked. And October definitely did. This comes to us from Napa-Net, the National Association of Plan Advisors. And this is written by the Napa-Net staff. October frightful for the average 401k balance. You're probably better off in October if you just didn't look. It doesn't say that in the article. That was Joe commentary. Let's go to the piece. Several of the most infamous stock market declines in history have happened in October, which turned out to be a bit of a fright for the average 401k balance. Snapping a long winning streak, estimates from the nonpartisan Employee Benefit Research Institute noted that the average 401k account balance for younger, that's 25 to 34, less tenured, 1 to 4 years, workers slid 3.7% in October, a sharp turnaround from September's 2.2% gain. So, you lost all of September. You lost most of the summer as well. Among older, that's 55 to 64 workers with more than 20 years of tenure, whose average balance is generally more influenced by market moves than contributions, the average 401k balance dipped 4.2%. 4.2. So your 401k balance, even though you were putting money in, went down 4.2. So think about this. You're adding money. You've been in the workplace for 1 to 4 years, and you still lost 3.7% of your money. So all the money that went in, plus the market losses, is 3.7. And then if you're an older worker, you lost 4.2%. By the way, 4.2% doesn't sound like a ton until you start thinking about this. You start thinking about, let's say that you've done a good job saving for retirement. Let's say that you've saved $1 million toward retirement. You lost $40,000 in a month. And it's funny, and we've said this before, percentages sound like, oh yeah, 4%, no big deal. But when you think about the fact that you lost $4,000, $40,000, it's a whole different feeling. Very, very whole different feeling there. So let's dig in even more to this piece. For the third quarter of 2018, the average 401k account balance for younger, less tenured workers was up 11.2%. So because you were putting money in, you went up 11.2 for the entire third quarter. Among older workers of more than 20 years, your balance went up 5.4. Once again, your balance didn't go up as much because you already have a bunch of money saved, and it's more based on what the market does. In the early days, your return is much more based on what you do. Then, as you get closer to retirement, what you do still matters, but not nearly as much as what your funds do. That's why we always talk about just get started. Asset allocation doesn't really matter a ton. It matters, but not a ton. It matters way more, way more later on, which is why I think that the idea of a 22-year-old using a Robo advisor is somewhat ridiculous, but that's a whole different show. No need for a 22-year-old to use a Robo advisor. A 50-year-old, I can make a great case for that. Not a 22-year-old. All right, back at it. The EBRI estimates are based on the actual contribution records and investment choices of several million consistent participants in their database. That analysis, based on their huge database of some 26 million 401k plan participants and more than 101,000 employer-sponsored 401k plans, representing nearly $2 trillion in assets, is unique because it includes data provided by a wide variety of plan record keepers and therefore portrays the activity of participants in 401k plans of varying sizes, from very large to very small, with a variety of investment options. So when we talk about this data, not looking at 100 people or 500 people, looking at hundreds of thousands of people. October was ugly. And I think there's a big point here, which is this. I saw lots of people gyrating about how bad the market was. And the thing that I didn't hear, that I've heard in the past, and maybe it's because October hasn't been as ugly lately, the market, more often than not, when it's going to be ugly, September and October are often two very ugly months for the market. So if the market's ugly in January or February, probably take notice. That's why the Bitcoin problem in February was so difficult, because generally in February, the market does okay, but not this last year when it came to cryptocurrencies. It's interesting to me that I didn't see people say, yeah, but it's October. Hold your thoughts. October is generally a horrible month in the market, which, by the way, also brings up the fact that you see lots of people say, well, maybe at the beginning of September, I sell my stuff and then I buy it back closer to the end of the year. And the answer to that is, but what about those years October is not ugly? What if you guess wrong? Not great. Let's move on to, well, before we move on to our second piece, let's say a big hello to people hanging out with us on Facebook. We do this live in front of a Facebook audience, which scares the heck out of me, but it's also makes it a little more fun because you're not sure what's going to come out of my mouth next. We actually put up a little tree behind us, and a lot of people are obsessed with the tree. Robert says, I see the tree and can't help but think of the line "Et tu, Brute" from Shakespeare's Julius Caesar. We were talking about how the tree already. But you know what? The stores are already doing it. If you're going to watch us live, I want you to remember just how many stores are waiting for you. That tree is to remind you to get your act together before you go to the mall, because they're already thinking about you. And it's incredibly scary how much money they spend on you and how little time most people think about making sure they don't wreck their year here in the last month. Aaron's here. Good morning to Aaron. Kelly is here. Of course, she's taking home the swag. John is here. Paul's here. And Kevin says, stomach churning for sure. This is when good financial advisors prove their worth. You know, it's when just having, frankly, Kevin, good people around you prove their worth. And it's funny because a lot of the people, going back to robo-advisors, worry about the fact that people see a robo-advisor and a human advisor as the same thing. And I totally agree. A good financial advisor is going to help people get through this, where a robo can't do that, which is why the name robo-advisor, I think, is tremendously unsatisfying and probably more to the point, a misnomer. It's an investment platform. There's no advisor included with that. And when there is, I also think that maybe it's it still is a misnomer, because I don't think that a machine has the ability to have the empathy yet that I think, even though science fiction movies will show me otherwise. Kevin also says, but when a 50-year-old uses a robo-advisor, does it include a human to talk him or her out of selling at the wrong time? No. But what it does, Kevin, and the reason I think robos are built more for 50-year-olds is because it makes sure that your asset allocation is much better. You know, going on this tour this last week over on the Stacky Benjamins channel, we're playing our live shows, which are with Bloom and TIAA. And Chris Costello from Bloom is with us. And if you listen to those shows, you'll hear him, a robo for your 401k, talking about asset allocation and about how as your assets grow, how that's more important, but how most people don't think about diversification as analytically as they should. And for a 50-year-old, it is far smarter to be analytical about your diversification. When you're 22, like helping my daughter with her 401k, she went all small cap value, like 100% small cap value. You know, if you've got $1,000 in the fund and you lose 20% of your money, I know you lost $200 and it hurts at 22 to lose $200. But think about this. You're buying so many shares so cheaply as you lose that. And we know that small companies historically have performed better over longer periods of time than large companies. So why not just do that? And then later on, get more analytical. But I will see 22-year-old, and I'm back up on my step stool, man. I'm back up on it. You'll see 22-year-olds give up free returns, what I think of as free returns, or very, very, not very costly returns. Let's put it that way, because they're afraid of volatility. They're afraid of losing that $200 versus, once again, if she was somebody with $1 million in their portfolio and they lost 20% of their money, $200,000, that is just it's a ton of money. Lori's here. Hey, Lori. Lori says, set it and forget it. If you're in it for the long haul, you'll be A-okay. Good stuff there. All right, let's move on to our second piece, which comes to us from Forbes. And Forbes is talking about the midterm elections. By the way, if you're listening to this on the day it comes out, go vote. I saw a thing on CBS Sunday Morning this last week about civics and about how people don't vote anymore. And it largely coincides with the time that we stopped offering civics in schools because it seemed like a waste of time and it was boring. And yet, once they stopped offering civics in schools, voter turnout went from not great to absolutely horrible. Realize if you don't vote today, you're giving away your vote. You're giving it away because you still vote. You're voting to hand your vote off to somebody else. So don't think that if you don't vote that you didn't vote. You did vote. You voted to give it out. So go vote. All right, there we go. That's my voting diatribe. Diatribe number 2 in one day for no extra fee. You're welcome. Forbes, this is written by Stephen McBride. I do not like the way Stephen writes. So how about that? Hey, Stephen, don't like the way you write. Stephen writes, here's how stocks perform over every midterm election since World War II. I do like that headline. And I'm picking Stephen's article, not because of his writing prowess, but because of the fact that I want to get to this point that he has given us. He says, are you prepared for Tuesday? It's going to be a crucial day for the stock market. As you likely know from the lawn signs dotting American neighborhoods, midterm elections take place this Tuesday. If the polls are correct, President Trump and Republicans are in big trouble. But by the way, is there any, and this is not meant to be a political statement. Are the polls going to be correct? Because it seems like the last election, the polls were nowhere near correct. Like if you think the polls are correct, maybe there's no reason to vote, but clearly the polls aren't correct. So go vote. See, I get right back up on my step stool, but let's go back. There's an 85% chance Democrats will seize control of the House of Representatives from Republicans, according to statistical analysis firm 538. This is causing big-time anxiety for investors who've enjoyed a 28% stock market rally since Trump took office. No matter what you think of Trump, his reign as president has been great for stocks, but as the election has drawn closer, the market's fallen apart. Yesterday, the S&P 500 closed out October for a 7% monthly drop, nearly its worst month since the financial crisis. And then he says, and this part I don't like, I'm going to tell you exactly how to invest ahead of Tuesday's big elections. Well, too late now. Few topics stir emotions in America like politics. Many perfectly reasonable people lose the ability to think straight when they hear the name Trump. As I always said at his firm, which I'm not going to mention because I don't like the way he writes, politics and investing do not mix. Super investor Warren Buffett often says, if you mix politics and investing, you're making a big mistake. So let's steer clear of opinion and emotion. Instead, I want to focus solely on the facts that are relevant to you as an investor. You know what? I take that back. I will say I'm using his article. I need to tell you where he's from. It's a risk hedge. As I always said, risk hedge. Let's be fair to this guy. So as you'll see, you don't need to waste even 1 second worrying about which party will win on Tuesday, because his team studied every midterm election since World War II. I was surprised by what we found. It turns out there's a shockingly easy way to predict whether stocks will rise or fall after a midterm election, and it has nothing to do with predicting in advance which party will win. Here's what we found. Since 1946, there have been 18 midterm elections. U.S. stocks have climbed higher in the next 12 months after every single one. Every single one. I'll repeat it because it's so important. For each of the past midterms, stocks have always climbed higher a year later. Always. We've had every possible political combination in the past 72 years. Republican president with Democratic Congress, Democratic president with Republican Congress, Republican president in Congress, Democratic president in Congress. The market always climbed higher every time. And stocks don't just grind higher after a midterm election, they often surge. Since 1946, stocks have jumped an average of 17% in the year after a midterm. And if you measure from the yearly midterm lows, the results are even better. From their lows, stocks jumped an average of 32% over the next 12 months. For perspective, that's more than double the average performance for stocks in all years. We're also entering the third year of a presidential term, which is historically the strongest year for stocks. And yet, lots and lots of rumblings about what's going to happen in the stock market based on this election. The election's important. You need to vote. When it comes to your stocks, though, historically things have done very well after midterm elections. So that's where we sit when it comes to midterm. Find that surprising? A lot of people find it surprising. Kevin writes, but this time's different. Buy an annuity. We'll have annuity salespeople showing up at your house, saying that. It's fun. Kimberly says she loves voting absentee in the comfort of her home, usually with a glass of wine. That's a fun way to, you know what? Put on some fun music, grab a glass of wine, invest some money. What am I talking about? Vote. Maybe the same thing, right? Invest in your future by voting with vote, by the way, with a glass of wine, not after the glass of wine, because you might not be able to take it back. Chris says, I'm amazed we have to remind people to save in retirement plans, even with headwinds. It's like reminding people to take breaks, vote, exercise, or eat right. It's very, very interesting. All right. In just a second, we're going to put these two together into what we call the big idea. But before we do that, I want to introduce you to this company, Hurdler, because I know we have entrepreneurs in the audience. And if you're an entrepreneur, Hurdler is specifically for you. Hurdler, spelled Hurdlr, is built for self-employed entrepreneurs, side hustlers, or gig economy workers. So if you're somebody who's just starting to build something so that you make a little extra money, we talk about that on the show all the time, or you're somebody who's established, been working on your side hustle or on your gig for a long time, Hurdler's built for you. It tracks all your expenses and mileage so you never miss a tax deduction. It gives you real-time tax estimates so you know your profit before and after tax. It tells you the taxes you owe and when to pay. The in-app tax filing instantly shares reports directly with your CPA if you want it to. And it links with your credit card and bank as well as Square, PayPal, FreshBooks, and Uber. So saving you time, money, and headaches on your finances and taxes, go to Hurdler, Hurdlr, that's Hurdler without the last E.com to learn more. Actually, if you go to stackybenjamins.com/Hurdler, by the way, that's the app. And by the way, you can kick the tires on the premium app for a month for free using our link, stackybenjamins.com/Hurdler. Almost forgot to put that in there. Got to make sure I change that in my little go-to script here. Fun stuff. All right, time for us to go to the fun stuff of this episode, which is the big idea. And today's big idea, we're combining a horrible October and people worried about midterm elections. How are we going to combine the two of those? Well, it's funny. You see people say, what do I do with midterms around the corner? What do I do? Well, first of all, you go look at stats, and then you find out that things usually go well after midterms. October was absolutely horrible. People wonder, what do I do? You go look at stats. You find out that when the market goes poorly, it often goes poorly in October. Nothing has changed. And yet, like Kevin said earlier in our Facebook feed, this time's different. Maybe it's different, but do you want to get caught on the wrong side of a bet? I like this idea of asymmetrical results that give me a high degree of upside potential and not much downside potential. A whole city, Las Vegas, built on, I heard this, by the way, on the Tim Ferriss podcast recently, a guy from this awesome restaurant, Alinea, Nick, don't remember Nick's last name, from Alinea, but a fantastic episode of the Tim Ferriss show, which I listened to probably 1 out of every 8 or 9 episodes of Tim Ferriss. I totally cherry pick episodes of that show. But this one, because I love the Alinea story, really interested me. And that whole episode I found to be amazing. I've already listened to it twice. But he talks about this idea of asymmetrical results, which is something I've always believed. Whole town, Las Vegas, built on people not understanding asymmetrical results. You have a 49.5% chance of winning at your best at Vegas, which people go, ooh, that's pretty good. That's almost half. Yeah, but there's so many options out there you can do with your money where you've got a 75% chance of winning, 80% chance of winning. And by the way, you want to make sure you're actually winning. People go, well, Joe, if I want a 100% chance of winning, I'll just stick it in a savings account and earn 2%. You're not winning. Inflation's beating your butt. So winning means what? Winning means starting with your goal and working backwards. And what's cool is this is how you find out, kids, where the asymmetrical results exist. If you know the time frame until you need your money, and then you work backward to today, you can then compare opportunities over that time frame and which ones gave you the best results. I'll give you 2 examples. The stock market over a long period of time, very low chance if you're diversified that you're going to lose money. Horrible over the short term. Like the roulette wheel might even be better over a 1-year period of time. So go down to the casino and just spin the roulette wheel and have a lot more fun than sticking your money in stocks for a 1-year time frame. But for a 10-year time frame, 15-year time frame, go look at historically how often you've lost money over those time frames. Very asymmetrical results. Small chance of losing, big chance of winning. Same for real estate when you look long term. It's exactly the opposite for a savings account. Big chance of winning over the short term, horrible win conditions over the long term. You stick all your money in a savings account for the rest of your life, you're going to have to save dollar for dollar for that long-term goal, or even more. And that's going to stink. I mean, imagine if you need $2 million to live the rest of your life after retirement, you're not earning any money. It's going to be tough. So start with your goals instead of don't start with October. Don't start with, oh my goodness, the stock market's gyrating. What do I do? You do nothing. Because your asymmetrical result means stay there in stocks or in real estate. When it comes to the stock market, Republicans or Democrats win the stock market, your stocks are going to be fine. You should still vote, but your stocks are you're going to be fine if you start with the end in mind. That's going to do it, guys. Thanks a lot for hanging out today, everybody, on Facebook. Thanks for hanging out at home. We'll see you next time back here at Money in the Morning.
Money in the Morning is created by Saul-Sehy and comes to your ears because of the collective genius of our producer, Richie Rutter-Reese, engineer, Caden Thompson, and a pack of very well-trained ferrets here in the basement. You'll find links to all of our headlines featured on today's show in Joe's Twitter feed at @AverageJoeMoney. I know you already know this too, but Money in the Morning is for entertainment purposes only. You shouldn't act on anything recommended by a bunch of entertainers in a basement without first consulting with your financial advisor and second, having your head examined. Have a headline you'd like us to discuss? Send them to Joe at stackingbenjamins.com or put them on our Stacking Benjamins Basement closed Facebook group. This show is copyright 2018 Stacking Benjamins LLC, all rights reserved. I'm Joe's mom's neighbor Doug, and I reserve the right to always say, we'll see you next time back here on Money in the Morning.